All right, do some investors today. So, great thing about investors is they are usually repeat clients if you make the money, of course. So, I think they're good people to work with. I think you'll definitely see a lot more, keep flooding to Alberta. Ontario market is pretty bad, especially on the condo side. It's crazy right now. There's 80 months of inventory of new condos in GTA. Like, it's bad.
Did you say 8-0?
That's
Yeah.
insane.
6.5 years of inventory?
Yeah, it's bad, dude. There's so many towers, and that's the thing, right? It's like, oh, okay, prices are cratering. Like, go get a condo if you like need to buy something, right, as a homeowner. But if your building's not even half full, like it's so risky anyway. It's
Paying 1,600 a month on condo fees.
yeah, condos prices are at like 20-year low or something. It's crazy. It went fast. Like that's like super fast. So I think Alberta gives people a lot of well, good opportunities still too. So kind of quick three-part breakdown. So understanding the types of investors, analyzing properties, and then just going over all the tools to use to like get all the data to analyze the properties. So the investor toolkit. I do have the ROI calculator all done and branded up, so I'll share that with you guys too. And you could just like make a copy of it in your Google Sheets and use it that way, or you can download it as an Excel form too. Anytime you want to analyze a property, and then you can like copy and paste it into email to send it to a client, that kind of thing too. So it works really well. So good investors are repeat clients. A lot of them do buy in a 12-month cycle, 12 to 15-month cycle. So you will get like deals every year from the same people, which is nice. I've got some where I get like anywhere from 1 to 3 deals a year from. The nice part too with investors is they will have their own homes to sell and buy every once in a while too. So you get the little extra if you've been working with them already. Builds your expertise in the market and market cycles. So really understanding when is what is a good deal, when's a good time to buy, that kind of thing. Investors are most likely to refer you more business, and it's less emotion based. So which is kind of nice because sometimes home buyers will change their tune on a dime, as we know, and decide not to buy for a million reasons. So a couple different types of investors. Of course, you have your new investors. You will get that a lot. You'll get people that have extra money saved up, and they're like, "Okay, I'm going to buy a rental property." These clients need a lot of education. They need to, understand what the property should give them, like what kind of cash flow they need, what their goals are long term. I definitely recommend helping them build a team if they don't have one. So mortgage broker, yourselves, like everybody part of that team to make a decision. Accountant, if they're not working, like if they don't usually do their taxes with an accountant, try to push them to like set up their whole team, which would include an accountant, because there's a lot more decisions when you start getting into rental properties. Plus, when you sell them, there's capital gains implications. So they should really understand all of the basics and the behind the scenes stuff with the CRA too when they start buying rentals. Seasoned investors, obviously, they know the game. They're looking for realtors that will bring them things. So, like, these guys are not the ones that are going to sit there and want to auto search. They're going to want realtors to bring them specific properties that meet their goals. They love off market. That can be hard to get for people in certain circumstances, but anytime you can connect with another realtor that works in the area that you're looking for, or find someone off market, these seasoned investors always think that's the best thing ever. And then out of province, which we get a lot of now too. So need to be educated on the Alberta numbers. A lot of them don't understand where the rent rates are here. They also, if they're coming from Ontario, Quebec, really highly rent controlled places like that, then they don't understand the market fluctuations in rent. So really important to remind them, like, there's no rent control here, which is great. But when the market corrects, you also have to correct your rent. So it is like more of a free market in rent, which I like, but there are times where that rent's coming down. Where in Ontario and Quebec, it's kind of like ticking up at 1 or 2% every year, give or take. A lot of cash flow investments from Ontario, BC, like in the past, if they sold them, they might have a lot of cash to spend. So we get a lot of people coming here. There's low transfer fees, as we know, in Alberta. Lower prices on homes. There's strong tenant demand right now, and then overall, like lower operating costs, less tax on things, that kind of stuff. Quick breakdown where we sit right now in Alberta. So in Calgary, the overall vacancy is 4.6% as of the end of 2024. I assume that's ticked up again, but CMHC doesn't publish their numbers. They only publish their numbers every quarter. So don't have any other data. There are certain areas of the city though that we're hitting 6% by the end of the year too. So keep that in mind. There's a bit of a difference between quadrants. In Edmonton, it's still a lot lower. So anywhere from 2.9 to 3.3% of vacancy right now. Population growth was still strong this quarter, and year over year, Alberta's growth is 3.5% as of this quarter. So we're now at just over 5 million people population in Alberta. Purpose-built rentals, which I mean, they talk about a lot at CREB, and we've talked about a few times too. In 2024, over 5,500 rental units were built in Calgary, which is a new record for the city. So got flooded with a lot of inventory that definitely has a downward pressure on rents. So keep that in mind when you're doing numbers for people. Skew on the lower side of the average, don't round up, just to be safe. Oh yes, my other bar, which I think is important. So we know the purpose-built stuff's being flooded, which is mostly apartment style condos. I always steer my investors away from apartment style condos anyway, but I think very important to do so now because there's a lot of that on the market for renters, so really hard to stand out. If you have a really good property, newer property, basement suited, nice duplex, basement suited, even somewhere with a yard, somewhere with a garage, those are the things that stand out for tenants a lot more.
A big thing too, just to that point, Andrew, is that just the way the interest rates are and minimum down payment requirements, if you're working with a first-time investor, you know, depending on what they're doing, if it's like just a cash deal or if it's going to be a financed purchase, when you are getting to the back end and looking at what your monthly expenses are going to be, you know, an apartment style condo is going to have a condo fees attached to it. And so you have to include that into what's coming off of your bottom line. And that can a lot of times be the difference between whether you're cash flow positive or not too, right? So
100%.
you know, you can find a nice townhome that's bare land or freehold, sorry, and you know, for 450, you can find those and you can rent those out. And rather than paying $400 a month condo fees, you're putting that 400 a month cash flow.
Yep. And even like it's almost impossible to cash flow in a condo right now in the downtown area because I mean you're 800 to 1,000 a month in condo fees, like you said.
And you can't make that up in rent.
No, people aren't paying for it. There's a lot of places to rent downtown still, so yeah, you got to be careful where you buy. I mean, I had a guy reach out to me a couple weeks ago and he's like, yeah, I'm thinking maybe I should buy like 3 separate condo units. And I was like, how much cash do you have? He's like, oh, 200K. I was like, it would definitely not be the right play. And I showed him like if you have 200K, like why don't we go buy a suited house that you can now rent like 2,500 up and like 1,600 down, and you don't even need to burn all the 200K on your down payment, and it'll cash flow like $100 a month or just under to start, and that'll get better and better over time. And now you have like a really solid asset if you want to dump it at all. And that asset will increase the most too over time. Like detached product in Calgary increases the fastest over time. That's what people want here. Duplexes with suites do well also, but that detached product, if you can get it, it makes a lot of sense if you can make it at least cash flow a little bit or break even. All right, so couple things to always keep in mind if you are talking with investors. So obviously the return on investment, that's what they need to know. A lot of investors want that broken down annually. usually I'd run stuff on a minimum 5-year cycle. So like you're going to hold the property for at least 5 years. So here's your numbers after 5 years. But it's going to depend on their goals too. So if they're like, yeah, we'll hold this for 10 years, you can run the numbers on 10 years. I have the spreadsheet set up to like kind of run everything on 10-year cycle. So you just have the 10 years. But of course, most people renew mortgages at 5-year cycles. So the numbers will change out that back end of the 5 years, but just give them a good look on the property. Cash flow, not always a priority though. So obviously people don't want to be negative cash flow on a property, but some investors won't care if they're break even for first few years, 5 years, whatever, as long as the asset's going to grow over that time to make up the difference. So some people won't care. Most small investors though obviously will want some cash flow. So that's something to keep an eye on. It has been really hard to get good cash flow in properties. With rates coming down, it's getting better now. Like there are some. We'll run one here too, but there are some good ones right now. But it has been really hard with rates in the 6s for investors. Like they're only just coming down to the mid 5s now on investment properties. Cap rate. So cap rates work much better on larger properties. So if you have people buying fourplexes, I mean, that's getting up there, kind of give you a better look. But apartment buildings and commercial assets work a lot better on cap rate amounts. That being said, a lot of investors from Ontario will ask you what the cap rate is. They're used to it. That's how they like to run their numbers. All the investment groups like to use cap rate as well. So a lot of them will throw that out there. So it's good to know what it is and we'll go over it. And it's good to have the number, and I have the spreadsheet set to give that number to. Just so like we have it all, but basically you need to know your NOI and you need to know, the price of the property. Is there anything, I don't know, I mean, Eric did at least one investor last year, but is there anything that like comes up from the investor side, like what they ask you about properties?
Not necessarily property specific, but to your point, I think a lot of initial early investors are looking for cash flow. The idea of them holding an asset and just sitting on it isn't what they're looking to get into it for. They're looking to actually put a couple extra bucks in their pocket every month.
Yeah.
So, and again, like with interest rates coming down, it's helping. Are you advising them to go variable on their mortgages, or?
I mean, I try not to advise them on it. I would if they ask what I'm doing, I'm a variable right now.
Okay.
But like
That changes the calculation because it's higher right now, right? So
it is higher. It's also hard. Like the rate's still pretty high, even for the fixed on the rental side. Like
what is it, about 4.5?
At least, no, it's probably more right now. Probably more like 5s.
For a 5-year,
Well,
for like a 3-year fixed?
3-year might be under 5 now, but for 5-year, you're over 5 for sure on a rental. For a homeowner, you're under 4 now for insured mortgages, and you're about 4.2 to 4.5 for uninsured mortgages. But the rental side's always at least a half a point higher, sometimes 3/4 of a point. So it just depends. If they can get a variable -1, which sometimes you can on the rental, then it might be worth it right now for sure. But try to push them to their mortgage broker on that, just so we're not giving advice that we're not qualified to give. And then when they have a plan, then you can help them run the numbers too. So it's like, okay, I'm gonna go variable. This is the rate right now. All right, let's run the numbers at that rate so you're comfortable with that property.
I'm pretty sure, like I'll double check, but I'm pretty sure last year the one that I was working with, they got a 3-year fix for like 4.6.
Yeah, the 3-year. I was looking at JJ's 3-year money yesterday. That might be right.
And
Yeah,
I mean that was last year. So
3-year money is definitely cheaper right now. So your return on investment, most important thing to ensure you capture is all the expenses in these calculations. You could give an ROI based on some loose calculations, and you could be off by like hundreds of dollars a month, which is your cash flow. So be careful in doing that. I have the spreadsheet. I'll show you guys in a minute. So you can run them through the spreadsheet, kind of see the overall ROI. There is a disclaimer in the spreadsheet that, you know, buyers need to actually check their own numbers, and you're not like saying this is for sure numbers, it's just estimates. But make sure you're having that conversation too. So if it's a new investor, you're gonna have to walk them through it and just say like, hey, this is what we use as averages on some of these numbers. You use the real numbers where we can, but you know, we gotta double check everything. And if we're like offering on a specific property, let's double check it again to make sure everybody's comfortable with it. Cash flow. So like Eric just brought up, most small investors definitely want cash flow. So even if it's a small amount, that helps you cover off bad months. It drives higher return on investment over the cycle of the property as well. And then sometimes giving up cash flow in the short term can make sense. Or in the case of some bigger investors, they might give up cash flow for a few years, as long as it's a roughly break even property to gain on equity. Now, again, that you got to be very careful on the product that they're shopping for that, so that they are making money. And then cap rates, like I mentioned, honestly, I try to only use them on the larger properties, gives you a better breakdown. Also, once you're into commercial properties, so any multifamily 5 units and up, or any commercial lease properties, the bank will use a cap rate to help set the value of the building. So once you are into commercial mortgages, cap rate does really apply to how much the building is worth. So that's your net operating income. So that's all the rent coming in minus expenses, not including any mortgage debt ratio, divided by the property value. That's going to give you your cap rate.
What's a reasonable cap rate variance right now that on a single detached property right now? What are people jumping at that's acceptable to them? 6,
Well,
8?
on bigger, yeah, like you're gonna be like, I think it works out like on the suite properties, you're probably working out to like high 5s realistically if you were to do cap
Really?
rate. That's
Okay.
why it doesn't really work that well, because
Yeah.
what you care more about is cash flow on those, and cash on cash return stuff. On the bigger stuff, multifamily, you're in the 5 to 5.5 in Calgary right now. New product is like, the banks will do it at high 4s still right now, which is great for the investor because the buildings are worth a lot of money. Once you get out to Cochrane, Airdrie, Okotoks, if you're buying a building, you definitely want to be in the 6s if you can, to be safe right now. 6.5, 7. So, all right. Let me share my other screen. 2 seconds. Okay. So this is the rental calculator. We'll share this after the meeting, and we'll have the link in school as well. So in this, I've highlighted the boxes that you basically would enter the information into, and then it's going to spit out your 10-year kind of assessed value, loan balance, cash flow, equity, etc. on this side. And then you can play with this. So I will show you market growth rate, rental growth rate, expense growth rate. These kind of things usually kind of just peg at inflation. Inflation's been pretty bad the last few years, as we all know, so tough to gauge exactly, but there's some things built in there just to give you and the investor a little better picture of like further down the road what things are going to look like. But just to start, purchase price goes in the top, and then you'll put how much down payment they're putting. For a rental, you need to put 20% down or more, unless they're living in it, you know, one of the units, then they can do 5 or a lot of the time, but most of the time it's gonna be at least 20%. And then you're gonna have agency fees. We don't usually pay fees on the buy, except if it was like an off-market thing or something, maybe you were charging the buyers to pay you on the buy or something. So there is a box in there for fees, but most of the time not gonna use it. Legal fees, property inspection, any renovations they would have to do right away, and any repairs they might have to do right away. You could budget that into the spreadsheet. Down here you can put the interest rate, so find out what interest rate they're looking at and what they want you to run. amortization period, again, having a non-condo product helps with this to get your 30-year every time. And then on larger stuff, so apartment buildings, that kind of thing, you can get 40 and above amortizations now too. So there can be some big numbers in there. This will spit out your monthly mortgage payment based on your rate and your loan value. Property management, if they don't know property management amount, 10% is your good base number. Some managers are 12% now for the smaller product, but like we do have a couple of partners that do it at 10. So you can run 10 for them. Even if they're not using a property manager at first, you should put the number in. So like if it's a first time investor, oh, I'm just going to manage the property, it's just down the street. No problem. Let's just put it in, because there's going to come a point where you're not going to want to manage it. Or maybe you do grow your portfolio. Now you have 5 properties and you're not managing them. You should know what that looks like. And if they end up managing it themselves, then they can credit that amount back to themselves, but like they're putting the work in anyway. So like we should know if the property works with you paid a property manager. Property tax. So if you put the monthly amount in here, which you can find obviously on the listing, or through the city or town. Insurance, they should have get an insurance quote while they're shopping for properties would be the best, like from an insurance company, like how much are you going to charge me for a rental property insurance, because this should include any missed rent. So if there's damage to the property and the tenants have to move out, like insurance needs to cover their rental amount. So, and insurance should cover them their max rental amount. So if they're like, yeah, I'm planning to rent this for $4,000 a month total, they should be covering 48 grand in case something happens to the property. So they should have that conversation at least, so they know the amount, they can give you the actual amount. But I mean, I was running no more than like 125 a month. But that was a couple of years ago now. So 150, 160 a month is probably where we're at. Well, actually, Riley, you still have a rental, right? You have the insurance on that one? Oh no, you sold that one.
No, that's sold, but it was around the same also.
Yeah.
And usually if they some investors can group it into their auto policy and get bundles anyway. So I think that's probably still pretty reasonable, between 100 and 150 depending on how big it is.
Yeah, if they have multiple properties, you get discounts too. Vacancy rate. So I put a note here, but if vacancy is greater than 5%, you should be using the real number in here. If it's under 5%, you should use 5%. As it will fluctuate. As we see, it's going up in Calgary. We're probably past 5% when the new numbers come out. So always use at least 5%. And if it's like 7%, you should use 7%. This number is just going to be the amount of money the client should be putting away every month to cover vacancies. So that money is going into their bank account. It's just they should be saving it up. Again, if they don't, it's not your problem. But they should see the number because they should be putting it aside. And that's how I always ran mine, is like 5% out and 2% maintenance costs. And then that just goes in a savings account for the property. And just like I had multiple properties for a bit. So I had each savings account was like the property address in Tangerine, because you can open up free ones. So I had multiple savings accounts. And so each address had money going in for that address and saving up in there. That way, if I had a month on turnover with nobody in the property, I had $2,000 saved up. So I'm not negative cash flow for the month. I can just draw it from that if I wanted to. So that should be your savings.
Question for you, Andrew, and I genuinely don't know the answer. So if for vacancy rate, does it make more sense to pick, say you owned a rental property in Calgary, would you put the vacancy rate for like all of Calgary, or would you put like, maybe if it was a condo, you'd put for the condo specific vacancy rate? Like what is a better way to go?
Like if it's a condo product and more prone to vacancy, like downtown or something, I probably want to use that specific area, which will be higher.
Right.
And I'll show the CMHC rates. Yeah.
Okay.
I would always go on the side of caution. And like if you're putting away that amount of money and you're still break even or making money every month, then you're golden. and it's
Yeah.
still your money. So it's like if you got 10 grand saved up. So how I had my brother as a partner on a property for a while, and how we did it, it was like we always saved up the money every month, but if the account got over $10,000, then we were allowed to draw like 2 grand each that month.
Yeah,
Take the
threshold.
money back to our pocket. Yeah. So you can always run it like that for yourself too, where it's like I'm saving up, but it's like, I got 10 grand in there. That's like 5 months of rent. I'm gonna take 5 grand out and use it.
One
Yeah.
quick note for you guys too. This sheet makes you look like such a pro with clients. Like if they're asking, I want to buy a rental property and, hey, guide me, because I would say most clients don't really know what they're looking for when they're looking for an investment property. Like they're looking to us for guidance to tell them, what is a good rental property. So, when they start sending you guys properties and, you plug them into here and you show them like, hey, you're negative cash flow on this, you're negative cash flow on this. And then you're like, well, show me one that's good. And then you can put one in here, especially doing a Zoom call and sharing your screen and showing where you're finding it on Pillar 9 and then putting it in here and like doing it together with them. It's really powerful. It'll build a lot of connection and make it a lot easier to have clients build that trust with you.
That's a good call.
Sounds like also like this spreadsheet should be very conservative,
Always, yeah.
right? Like it should be worst case scenario for rental income, and then worst case, not worst case, but just very conservative on rental income, very conservative on your operating costs. So like you don't want to leave any room for it to go the other way.
No.
You know what I mean?
And there's always disclaimer too. Like, and
Yeah.
I would always say this to every investor that I'm working with, like, hey, this is real estate. There's always going to be risk, right? I'm going to guide you as best I can. This sheet is going to give us the best shot to win and like get a really good rental property, but things can change, right? Rates can change, vacancy rates can change, cost of rent can change. But as of today, this sheet should land us within probably like 1 to 2% accuracy, right? Which if we can get the client that close, no one's perfect, right? No one's getting a 100% clear shot. You might once in a while, but at least this is getting us really, really close. And then you're right. It's just like, hey, here's a disclosure. You know what I mean? There is still going to be some risk with this. Same with stocks. Just because it looks like this stock's going to go up and all the financial analysis says it's going to, doesn't mean it is, right? But you're an investor, so you should be okay with a little bit of risk.
If you're gonna send this to somebody, I would like copy paste the whole thing like this and drop it in an email body. That way the disclaimer's there too.
Yeah.
Like,
And it's not, and they don't just have the sheet, it's yours.
Yeah. I would maintain control over this because then they need you to use it, right? And then you can work through that with them.
100%.
So if you just copy and paste this and just send it to somebody's email and they click on it, it'll automatically like
if
just
you
go into
copy
that
paste this in
spreadsheet.
Gmail, it'll just show as like the spreadsheet.
Then when he clicks on it though, like the spreadsheet will be fully operational.
No, that would be just sending him a picture of it, just so you
Okay,
keep control of it. Yeah.
Yeah.
And then you just send him the numbers, like, hey, I ran the numbers for you. Here's what we're looking at.
Copy.
Yeah, and that way it's like your extra value add too.
Hey, can you just send me the working spreadsheet of this? No, I can't. It's proprietary.
Yep. Yeah, just keep it in your back pocket. Utilities on here. Obviously, some investors will pay for utilities, some will charge it. I always recommend charging the tenants straight up. If you lump stuff in it, you're always gonna somewhere down the line you're gonna miss money. But obviously up to them. So find out what they're gonna do on a given property. Sometimes utilities aren't separated on a suited property, and it's just they find it easier to pay and just up the rent. So just find out what they plan to do. Repairs and maintenance, again, this is just savings. So you're putting away every month for stuff that's going to come up, and stuff will come up, right? You're going to have light bulbs that burn out. You're going to have things that break. We got to make sure that you have money put aside. So remind them, like, vacancy and repairs and maintenance, like that's your savings. So we're going to account for it in your cash flow calculation, but that money is going into your bank account. Condo fees, if it is a condo, and then anything miscellaneous, there's a box for it too for you guys. Rental income, self-explanatory. So this is separated to upper unit and lower unit. If they're buying like a fourplex, then just put, you know, the 2 uppers, 2 lowers, or just combine it all. Doesn't matter. You're just looking to have this total rent amount box equal the total amount of rent that's coming in. You'll see down, you're going to have a cap rate based on your NOI here, and then an estimated cash flow. So, where is it? I did pull this property earlier, which is a pretty good one, actually. It's a 5-bedroom detached home. So we'll run the numbers on that in a minute. But wanted to show you guys, and this is going to be in the training slides and in the resources after, but a few things to pull stats from. So let's say you find a property, this suited one in Livingston. It's pretty new, 2022. It's got a 2-bedroom basement suite. So you're looking pretty good rent wise. I always do a quick flip through the pictures and make sure, I mean, this one's pretty much brand new, but make sure they're pretty nice. Which this one is. So that's your basement. And your upstairs. RentFaster has average reports. So this screen here, you guys can see that, right? This screen here has your average rents for each city. So you'll see Calgary, and this goes every month. So Calgary studios went up. 1 beds came down. 2 beds went up last month. 3 beds came down slightly, and 4 beds came down 2.2%. So you have the average rents. So that's one thing to look at. Now that's not very specific. So if you want to drill down, make yourself a landlord account on RentFaster. It's free, doesn't matter. Just sign up as a landlord account, and then you can go into the rental stats search function, and you can save searches and stuff too. So just make yourself a landlord and RentFaster. You can look up, so you start with city, you can look up all the different types. You can look up the beds, make sure that's all filled out. Anything that's equivalent. So if it's like a 2-bath or 2.5 bath, I just select everything here. Unfurnished, furnished, and then you can put in an address or landmark to do a proximity search. But what's the most powerful is usually just doing a neighborhood search. So obviously Livingston, you should include Carrington. You can probably include Evanston even, because the eastern part of Evanston basically touches the back part of Carrington. So like give yourself as much of a general area as you can in this thing. Evanston. Oops. And then this is gonna be a main floor technically, because the basement suite's a separate suite. So we run the main floor first. That's 3 bedrooms up, 2.5 bath, unfurnished. I have my neighborhoods. You can search that. And you can see what's going on average in the neighborhood right now for listings. Or it's not gonna load. There you go. So you see your average is 2250. The highest one right now is 2650. And then your like low percentile is $2,000, let's call it. So that's kind of where you're sitting for what people are asking for main floors, with basement being a separate suite or no basement, and what they're asking for rents right now. Now you can see like how many listings are up too, which is kind of nice, because you can tell if there's a lot of the market or not, and they can check average days before people mark them being rented. Now take this with a grain of salt. Some landlords don't go back and mark them rented, but a lot do. Just gives you kind of idea of how long it's taking people to find tenants. Sorry, go ahead, Rick.
So this is only the landlord thing, because I haven't seen this on the regular RentFaster. This is fantastic.
Yeah. So just make a landlord account, and then you'll have these tools in there.
This is new for me too. I didn't even know that. I mean, I can usually pick off, like I would say in my head, main floor 2,300 like right away, just because I know
Yeah.
that. But this I would love to have. Like this is great.
Yeah,
Well,
like some neighborhoods are quite different because they're, you know, maybe really old houses.
yeah.
You're gonna see the rents different, and a place like these where they have a lot newer, and like, you know, we can get Evanston obviously have different products, so you might just want to focus on the new ones. At least it gives you, okay, this is what's up right now. So I know if I for sure want to rent my top floor, I can come right under the other listings, and I should be able to get it rented faster. So like at 2,200, you'd expect it to go faster. If you're like, oh, mine's nicest, I'm putting it at 2,300, you might wait a little longer for tenant.
That's
And
awesome, dude. This is a cool little.
and one thing I would err you guys on the side of caution too. So look at those number of listings. If there's only 3, you know, it's a small piece of data. Like it's still good because those are listed right now. If there's 15, you know, obviously it's pretty saturated. There's, you know, a lot of people are trying to rent it. So it's kind of just look at your numbers too, because if there's only a couple, it can skew different ways fast. Some landlords are also just like sellers. They have aspirational rent prices that they want to. So keep an eye on that. One thing I always do for investors too, just to give them a little bit of a leg up, I say, hey, once you close on this place, I'm going to get you introduced to our professional photographer. You guys are going to pay for it, but let's get our professional photographer in there. Let's make your rental listing stand out. You know, let's make sure it looks really different, because I would say at least 85 to 90% of landlords do not take professional photos. So even just getting professional photos, it's just like a listing when you sell it, it looks way different. Like when I had my rentals and I put them up on RentFaster, they looked like houses for sale. And I got dozens of applications, and it allowed me to charge a premium on rent, and I got a premium tenant because my listings, my rentals just look the nicest, right? Like they look like luxury little rentals. People are like, holy shit, I want to live there, right? So
If
we
if the
can guide
listing
them.
if the listing sorry Riley, if the listing photos off the actual listing are professional, can you buy them and reuse them?
Of course, yeah, yeah.
Okay.
You can
Okay.
call the other realtor.
Yeah.
Sometimes if they're cool, they'll just say, "Hey, man, it's sold already. Here you go. Here's the link." Be careful though. Don't just take them, because
Yeah.
there are realtors out there who will call you out and get really angry. It's happened to me before. I only took one photo for this listing because he had a nice backyard shot of this luxury house, and he just caused a shitstorm. So always ask.
Yeah.
Yeah, ask or buy.
You know,
Forgiveness permission does not work on that one. I've tried.
once it's in public domain, you can do whatever the hell you want with it.
You can't.
No.
What?
You still don't have the rights to it. You can't pull it off Google and use it on your own
As
listing.
long as I'm not monetizing it, how can he do anything?
Well, you are monetizing
you're
it.
a real, yeah, because you're a realtor. Your client could take them. I mean, you couldn't really do much about that. But if you took them, then yes,
I've done that. I've done that a lot.
Yeah,
and you know what? Most times you're probably fine, but on the ethic and just code of conduct and how realtors treat each other, you know, like it's kind of, yeah, like, are you gonna get sued? Probably not, but are you gonna get an angry agent once in a while that is like, they blacklist you because they just don't like that and they're old school? It's possible. It's happened to me. I had to apologize and blah blah blah, and he was a little bitch about it. So
I don't like, I'll give mine away about 99% of the time, but like, yeah, people gotta call me and ask if they want to use them, and then half the time the other realtors just send me $100 anyway.
yeah.
And I'm like, yeah, I don't really care. Like, I'll just email you right now. Sweet. All right, we'll take it.
Sorry to hijack this. Can you do the basement?
Yeah, that's what I just pulled right now.
Oh, okay. Because I'm literally going to send this listing to one of my clients as soon as we get off this.
One.
Yeah.
Like, so 1,400's kind of the average right now for the listings. On the basement, I almost want to see the listings. They should be all pretty new and stuff, but like, because I agree with Ryan. Like, anytime I've got a rental, I went in and got pro photos. I got 3D tour done, got iGuide done, and did a video tour, because once you have those assets, you look so much better.
And it's a big value add for investors when you guys say, not only can I find you a rental, I can project the cash flow, I can project your equity, I can give you the tools to market this so you get the most rent. I can introduce you to a property manager, can introduce you to cleaners, can introduce you to painters to increase the rent. Like now we're adding a lot of value to that transaction for that investor. And investors, at least good ones, they would rather the agent source it, find it, comp it, send it. Hey, Mr. Investor, this is a good buy. Let's go look at it. And they're like, awesome, great. We're doing our job and we're doing the work for them versus setting them up on a search and them saying, hey, what do you think of this one? Or let's go look at this one. You can already tell them, like, let's not go look at this one because it doesn't even work. I already ran the numbers and this is not a good buy, right? You get a lot of trust and credibility by doing that.
Yeah, this one's 14. This is your closest comp probably for size, which usually these lane homes are the same equivalent basement size as the duplexes. This one looks like it's a walkout, probably bigger.
And that one guy's a liar. Look at it, 1,800 square feet basement. That's not right at
Yeah,
all.
no, he put the upper like square footage in the basement square footage. So
Yeah.
he messed up that listing. So I think you're safe at 14 for the average. So 14 and
So this one's bringing in 3,700 a month.
yeah. Yeah.
$290 a month property tax.
What are we doing? Oops. What are we doing for the top? 23. Uh-oh.
You got to fix that cell.
Yeah. All right. Let's do what's taxes?
$290 a month.
Thank you. Insurance, leave 150, vacancy 5%, utilities, we're not gonna pay, repairs and maintenance are there, property management's there. What do we say we're getting? 4.6?
Yeah.
And 640 for your purchase as well.
Oh, I'm getting that bad boy for 620.
The average market growth rate in Calgary over the last decade is 2.8 something percent. We had a pretty good decade though. So 2 to 2.5% is like the safe number to be going at. Rental growth rate usually between 1 and 2% is the minimum every year. We did see some spikes the last few years. I would honestly just leave these at 1.5 and 1.5. We don't know where inflation goes. If you have somebody that's really nervous about what's going on and stuff, maybe you up those a bit as far as expenses because things are going to cost more. But I think it's a decent placeholder. All right, loan values 512. This will be a 3-year fixed. You can, at those numbers, if you knew what they were getting, you can always just update this for them. 30-year amortization should be no problem on this kind of product. You got your monthly mortgage payment, you got your expenses, you got your rent, cap rates are around 5 if you needed to give that number, and then your starting cash flow, you're just cash flowing technically.
And here's the cool thing with this. Like, okay, you look at that and you're like, okay, I only cash flow $6 a month. Okay, but these numbers are super conservative. We've got everything in there: vacancy, maintenance. That thing's brand new. There's not going to be any maintenance, but we want to put it in there just because it's the right thing to do. But if you look at the asset value over time, you look at the loan balance, and you show, hey, on your 5-year return is 135,000. So it's like you don't necessarily need to just look at cash flow, especially in a higher interest rate market and kind of where we're sitting right now. You want to look at like the actual total return. And if you look at year 5, using these numbers, they've got $266,000 in equity and 100% return on their cash, right? those are the more powerful numbers, so you can paint the long-term vision for the investor versus just, oh, well, I only cash flow $6 a month, I'm not buying it. It's like, okay, but look at what happens in 5 years, right? It's a lot different as you start to pound away at that principle. So an annualized return of 15%, which is great. You know, this is a good buy in my books. And if you look at I was just saying, if you look at the debt versus equity graph on the bottom, that just shows how your debt and equity, when they intersect. When they intersect and your equity surpasses your debt, that obviously is happening right around year 9, it looks like. Now you're in a really good position on that rental property. You can refinance, pull money out, do it again. And you can obviously do that before you hit that year 9 mark. But this is a really good visual representation to show people too.
Once you are at below 65% loan to value ratio, you can change your entire mortgage into a home line of credit. Like basically it's just a line of credit instead of a mortgage, even on a rental property. Some banks don't do line of credits on rentals, but some do. Like there's multiple of them that do. So you can change your entire mortgage into a line of credit at that point. You can refinance, like Riley said, and pull cash out. So you have so many options once your loan value ratio gets back down there. And if you're at 50%, I mean, yeah, you're laughing. You can pull out a ton of money. Go buy more properties. So, I mean, my goal has always been like by year 5 that I can pull out enough money to buy another one. And usually that works. If you find the right ones.
And get your cash back, right?
Yeah. So then you can, if I can refi, pull out 130 grand again, go buy another one. Or it might be, 170 at that point you need to pull out, but you can pull that money out, go get another one. You're laughing. You got 266 equity, and you can bump yourself back up to 80% loan to value. And Nick, you should always use a mortgage to buy a rental property.
Yeah.
Like people that buy, it makes no sense if people are like, I'll just buy cash. Like, but why? Your cash on cash return will it'll take you 30 years to get your cash back. It makes no sense. You should always utilize the bank on a rental property. If you want to own your house outright, sure. I mean, then I would argue you should pull out money and go buy more properties, but that's up to people. But a rental property, you should always have a mortgage on because you should always leverage the bank and take the cash flow because now you're gaining cash flow. And once you've made back, once you've made back your 128, so let's say at year 5 you will and you pull out 150 grand, your return on this property now is infinity because you pulled out all your money. You literally have no money left in the property. And that's one thing a lot of new investors miss. It's like if you put 150 in and you pull 150 out, now you're just making 100% money on this property all the time because you no longer have any cash left in the property. You're just using the bank to leverage it. So that's the powerful part. You should get to the point where you can pull that money back out as soon as possible. And now that's just all return. And you don't have to worry about how much cash left in the property. You're just collecting all your cash flow and you're gaining equity again. And it's just infinity investment. That's the real cheat code of real estate.
This is how people build wealth, right?
So it's the faster you can get to refi that and pulling all that cash back out, you're free and clear technically.
Can you just run through the difference on cash flow between year 1 and year 2 if everything's fixed?
Well, yeah. So that's if you had a variable adjustable rate or you refi, then you could regain the cash flow technically because of your loan balance. Okay. So it's not a realized cash gain. It's going to be that's kind of your cash flow on the back end. So if you could reset your mortgage on year 2 at that loan balance, then you're going to be gaining the cash flow.
Gotcha. Okay.
Yeah. So if you're on a variable and you're going to refi and rates went down and now your balance is only what it's at, then you just gained your cash flow back. Yep.
Okay.
I mean, it's a good reason to be on variables on rentals when it makes sense. I think it does now.
Yeah. But I mean, even if you can hold out for 3 years and then refi on a 3-year fixed again, I mean, you're doing okay. just no gain, like no cash flow for 3 years, and then 3 years you start realizing $2,000 a month
Yep.
cash flow. Like
Yep.
even that's
And yeah, and always like the 5-year return, you should be at least 100% of the 5-year return, honestly, on these suited properties. Like
And
from my experience.
here's a little pro tip for you guys if you want to use this to get leads, right? So, for example, social media on your story. Hey, for the month of May, I'm analyzing your rental property for free. Whether you sell it with me, whether you want to buy, I'm doing free rental analysis on any rental properties for the month of May. Just swipe up if you want me to do that for you and DM me the address and the details that you need, right? Send it a blast text out or an email to your database and say, hey, same thing. I'm going to be doing rental analysis and cash flow projections for your existing homes. Maybe they're like, oh my God, I thought this place was great. Really, their numbers are shit. Okay, why don't we sell that one and I'll go find you something better, right?
Yeah.
So that's a good way to use this. Use this as a free tool to offer value to people, and then you can have those conversations started, right? That's a good way to use this to get some leads.
And like in a good equity portfolio, you should be making, you can easily make 10 to 12% per year. So like my thinking's always been, and it's just me personally, but if I can't make at least 15% per year, like do I really want to go through the trouble of having a rental property? But I could just make 12% a year or just giving my money to somebody else. And if you're into like real estate investment stocks and REITs, like you can make 12 or 15% sometimes in those too. I have a really good one. I make like 10 to 12% every year. So my thing is always like if it's not making 15 to 20 per year, I don't really care to put in the time for that. But that's just kind of everybody's goals, and you need to kind of understand what they want it for. If someone's going to buy something and legitimately hold it for 10 years, you can see the type of return you're looking at. And no matter what, you will look at giant returns on 10 years in real estate in Canada, going back the last 60 years. So you can take that home to the bank any day. If you're going to get back all of your money in 5 years or less, then that's obviously an amazing investment. I've done as well as like 33% per year on some of the suited rentals I've had. ROI. So like there's some big numbers that can turn out. Obviously, interest rates were in my favor when I made that much. But you can make quite a lot of money on these. So like 15 to 20% should be your target. And then 20 to 30% is possible if the market goes up fast on you too. So like that's that equity gain. So these are pretty conservative numbers. If we hit another good cycle in 5 or 6 years and properties spike 20% in a couple of years again, like these investors could see returns in the 150% for sure. Questions on that?
one last one, just again on the going back to the long-term economics portion. Let's again just go back to a 3-year fixed. 3 years rolls around, they go back to their mortgage lender and say, listen, I want to start again with just starting off with amortizing it again, the new amount that I owe. I want to start that again over the 30 years.
Yep.
Does that long-term 10-year thing, is that amortized over 30 years, or is it re-amortized again from 3 years down so that these numbers would change?
Yeah, so this would be if you took the loan at 411 for 30 years again.
Okay.
Yeah. So yeah, that's the nice part if you don't pull out money. But again, honestly, you should be getting your money out as fast as you can. So it's out.
Yeah.
That's the key. And then you just get another one and do it again. So like it works, but people have to understand the whole game. There's ways to borrow money off your house and buy stuff too, but the interest rates really have to work and be in your favor to cover now 2 loans. So like there's stuff you can't do when rates are high. There's stuff you can do easier when rates are low. And if rates go down to, well, another 0.5% anyway this year, like it puts it in a really nice spot to be buying properties again. Because if you can hit variables in the low to mid 3s, it's great.
Oh, you're laughing.
Great.
Yeah.
Made a lot of money when it was like that last time. So all of a
This is
sudden you
great.
can cash flow like $400 or $500 a month sometimes.
This is great. I learned some stuff too, so thank you.
No worries. Thank you guys. Any other questions? I do have a little thing to do this week. So find a property, use the sheet, and then just like post one in the chat would be awesome in school. Just kind of get practice using the sheet and see if it makes sense to you guys, and try to find some rental properties. And yeah, if you do find rental properties that make sense, then do a quick video on it. You should put people like, hey, I got this rental, these are the numbers, you're gonna be cash flowing this much. It's in a great Northwest neighborhood. Like if you're interested in this, hit me up, because those are good ones to get leads to.
And if you guys like Crystal, you're a new agent, right? And I know you like social media and you're good at it. So imagine every Friday so maybe you do it earlier during the week, but then every Friday on your story, you're posting like a good rental property of the week, for example. And you're making a post, and then maybe you're making a story too. And every Friday, everybody knows that Crystal's going to put out the rental property of the week. That's a really good way for people to start engaging with you and sending you messages. You will get someone eventually. It might take 2 months. You might have to do that like 12 times. But eventually you keep doing that and your numbers are good. And you're like, hey, here's this rental property. Here's why it's good. And you just keep doing that same time all the time. You will get people to reach out to you. And then you get an investor and they like you and they help them buy one. And they're like, okay, well, I actually want to buy 4. Okay, boom. Now you got an awesome investor client. And then you can keep rinsing that, right? And it's super easy. It'll take you like an hour a week. It's not even hard, right?
Yeah, for sure. I never really thought of doing that, but yeah, this is great.
That's why you're here, right here.
Yep. I'll try to find it. One of the Keyspire guys did a blurb one time about infinity, like ROI. Like once you get your money out, like you're just making money. And it was really, really well written. It always stuck with me, because like so many people miss that part. Just like, dude, your money's out. You can go use that money somewhere else. Now you're just making money. You're just getting money back all the time. So like people should strive for that. If the real good investors do, and they understand that game, lots of people don't. They're debt averse, and they still will come to you like, I think I should buy a rental property, but they don't like debt and they don't get the game. That like it might not be for them. So next week, kind of on top of that social media stuff, I want to go through all the tools